Good afternoon, everyone, and welcome to Unlock the Stock with Afrimat and Capital Appreciation. Unlock the Stock is specifically formulated for retail investors to gain access to corporate management and to get to know them just a little bit better. This event is being sponsored by A2X, a stock exchange playing an integral part in the progression of the South African financial markets. A2X is the second largest stock exchange in Africa as measured by market capitalization. There is no cost, risk, or additional regulation for a secondary listing on A2X, and it provides issuers investors with the opportunity to save money. A2X currently has 94 securities listed on its platform, including 19 of the top 40 stocks, with a combined market cap of 6.8 trillion rand. The team at A2X are proud to be partnering with Unlock the Stock. Just as it unlocks value through its insights and key analysis, A2X unlocks value for stocks listed on its platform and helps drive the market forward. This platform would not be possible without our technology partner, Lumi Global. Their website is lumiglobal.com, and you can visit it to find out more about their various integrated online AGM and investor presentation solutions. Our hosts today will be the Finance Ghost and Mark Tobin of Coffee Microcaps, and they will facilitate the Q&A session at the end of the presentations. We would like to welcome to this session Afrimat, represented by Andries van Heerden, the CEO, and Colin Ramakubati, an Executive Director. For Capital Appreciation, Bradley Sachs, the Joint CEO, will take you through the presentation, and joining him in the breakout room will be Alan Solomon, the CFO, and Michael Shapiro, an Executive Director and MD of Synthesis Technologies. Before we commence, just a couple of housekeeping rules. Each company will do a 12-minute presentation. Thereafter, you will see a button at the bottom of your screen where you can join a breakout room to post your questions. This session will be 20 minutes in duration. You're more than welcome to jump from one room to the next. Please note that you'll only be allowed to post your questions by typing them into the chat function at the bottom of your screen. The event is being recorded and will be available on the Unlock the Stock YouTube channel, as well as previous events that we've had will also be visible there. Be sure to subscribe to the channel so that you can be kept up to date. Once in the breakout room, you will see an email address if you are interested in being added to the specific company's distribution list, so please take note of that. I'm now going to hand you over to Andries and Colin. Andries, could you please share your screen?
I will do that. Can you see it?
Not yet.
Okay.
I think we're seeing a team screen.
Okay.
Okay.
See it now?
Perfect. Thank you.
Thank you. Right. Good afternoon, everyone. It's always a pleasure to have the opportunity to present Afrimat and to tell you a little bit more about the company. And what I will be doing is just give you a quick background. I'm sure many of you are not familiar with the company and what we do. And then a little bit about our performance and where things are heading. And then after that, my colleague Colin Ramakubati will share with you our initiatives around the whole ESG side of things. So firstly, who we are. Afrimat has a track record of just over 16 years. We listed on the JSE in 2006 under the construction materials sector. And we started off as a construction materials company supplying aggregates and construction materials. Over the years, we've diversified the business quite well as the industry changed and the South African environment changed. We diversified the business and became a much more of a mining company. And as a matter of fact, we are probably going to be moving over time. We'll be moving the listing to the mining side of the JSE. The space that we play in is the what we call the mid-tier mining space. It's that space between the junior miners that really do not have the resources and the ability or the capacity to mine some of the more complicated resources in the country. But on the other hand, the resources that we mine are smaller than that is attractive to the majors. And we play in that mid-tier space, and we found that to be a very lucrative space for us. We operate in basically 4 different sectors. The construction materials I've mentioned, where we operate 25 quarries, a couple of sand mines, brick and block factories, ready-mix operations around the country. We then moved into industrial minerals, where we have limestone and dolomite mines, and we supply the high end of that market with niche products. So we go for the chemical grade minerals in that space. And then we have what we call our bulk commodities businesses, and that's really been the real success story of the last couple of years, where we have Demaneng mine, which is an iron ore mine we bought out of business rescue about I think it's about 7 years ago, and we turned that around and made that a successful business, and we export all the product on the Sishen Saldanha line to China. We bought an additional iron ore mine called Jenkins, not far from Demaneng, also in the Northern Cape. And that product, it's a very nice mine. It's a direct shipping ore, a relatively easy mining type operation, where we export. We sell our product locally to ArcelorMittal. On the domestic line, it goes to Vanderbijl Park and Newcastle. And then we recently acquired an anthracite mine in Mpumalanga called Nkomati. Once again, it was a business that was in business rescue. We tend to be quite successful in buying good assets that were not optimally managed, ended up in business rescue, ended up in trouble. We then get involved, return to basics on how we manage these things, make a big effort in really understanding the geology and everything around the mine. And we've turned Nkomati around. We're actually at the brink where the mine is expected to really start producing. We've opened up many mining areas. We're just about there now. Busy with the last bits of work on the upgrade of the coal washing plant. All of that should be up and running in the next couple of weeks, couple of months, and then we'll ramp it up to be in full production, hopefully by May, June this year. If nothing goes wrong. At the moment, we've got a little bit of a weather scare in that area that might hold us back a little bit, but we're watching it very closely. We're expecting the cyclone to move through that area towards the end of the week, early next week, which might cause a little bit of a delay. And then our fourth area of specialization is our what we call our future minerals business. That's an exciting new project for us. It's called Glenhover. It's a mine in Limpopo where we have phosphate, rare earths as a package of minerals in that area, as well as vermiculite, and all three of those minerals have an extremely good market potential all three of them strategic minerals. We are very excited about where that project could go over time. It's a new field for us, but it is something that we are getting in operation very quickly. We should start producing the first product, the single superphosphates, later this year. Hopefully by July, August, we'll start producing from there. So that's pretty much the business. The bulk commodities by far at the moment our biggest contributor to profits. We used to be very exposed to the iron ore price. We still are exposed, but with Jenkins being a locally priced product and in Komati now coming in, our reliance on the international iron ore price becomes less. On the graph in front of you, we show this graph to show what the value of our strategy is. The bottom line, the green at the bottom there, that is what we would have reported had we only stayed a construction materials business. And you see that it's pretty much just a sideways movement for the last 12, 13 years. But since we diversified the business and we grew the business, you'll see that gap, the red line at the top. That is the graph that shows what we actually presented to the market as their actual results. And that gap is really what the strategy has meant. And that was made up through acquisitions and growth into new projects. So that is pretty much a very quick update on what Afrimat is, what we're about. We're in a very strong financial position. Our balance sheet is extremely strong, actually in a net cash position as we speak. Cash generation is very good. We've been able to grow the business over time, mostly from our own balance sheet. We've only done a capital raise once, and we are still looking at some very exciting opportunities in future to grow the business and grow the portfolio further. So with that, I'm handing over to my colleague, Colin. Colin, you can just tell me and I'll move to the next slide for you.
Yeah, thanks, Andries. I think it's the only slide that I will talk through it. Basically, what I just like to share with everyone, good afternoon. It's basically Afrimat, we fully understand, and it's something we believe that in South Africa, social license to operate is key. All these assets that we operate with, the biggest difference that we bring, we believe in all these assets, it's our culture and the way we do things. And I just want to take you through a little bit of what we do to make sure that that side of things it's intact. And firstly, in terms of our employees, yeah, we really spend a lot of time investing on our employees. We spend a lot of money. We've spent about almost 6% this year so far on the skills development. 6% of our payroll, that's the amount that we spend. And we've created a lot of in-house programs that really teach our employees how to be better leaders and how to really live according to our values and our ways, because we believe it makes a huge difference and in everything we do. What has that done? I mean, we have seen over time that the absenteeism has really dropped over years. We have invested in things of like wellness program where we've seen, we believe, I mean, again, in the country that there's so many things that are not going well, which cause stresses on people's life in various ways. And therefore, we want to play an active role to make sure that our employees' well-being is taken care of, not just their physique, but also their mental well-being. So that's in terms of employees, that's what we do. And we've also seen the results of that we haven't had any labor unrest in the last couple of years, which really it's a huge win for us. As we operate a lot of sites, we have 75 sites across the country, and it's not easy to make sure that in all the sites you don't have any labor unrest, but we've managed to achieve that in the last couple of years. Also in terms of healthy, again, we want to make sure that our employees, they always go back home safe, not injured and in a good state. And therefore, we've also invested a lot in health and safety. And as we speak now, we are quite proud that we have achieved a lowest lost time injury frequency rate in Afrimat, in the history of Afrimat, where it's currently sitting at 0.34. Our target has been 0.5. We are continuing to push to make sure that there's no one end up being harmed in our premises or in our operations. Our audits that we normally do on a yearly basis continues to improve. The authorities that comes to do audits are quite happy with the way we do things, and therefore we don't experience any stoppages or anything from our authorities. And the other big thing, obviously, is our communities. And like I've said, I mean, with 75 sites and 44 mining rights, it's a huge task to keep that intact. And again, if you don't have a strategy, a way to engage them, or a way to keep them, keep the harmony, you will never mine in our country, as most of you will know. But we've got a proactive approach where we really make sure that we engage our employees in advance. There's constant communication with them. We've invested also a lot of money in our communities in terms of focusing on education and unemployment. And that's two areas that we're really proud that we want to make a difference in this country. But at the same time, if there's other needs that comes up, we do entertain them. As we speak, about 2-3 weeks ago, we were opening up a clinic, in one of our mines, which is in Komati, which is it's a proud moment again, because that clinic was a state of the art. Although it's a rural area, even the MEC of that province was so proud to say that we've built something that can easily be built in Santino anywhere in the world. And that's something we're proud of ourselves of. I mean, things that are still challenging, which we still also keep intact, is the business forums that the so-called business forums that happen in our communities. There's a lot of people come there and they claim they are a business forum, and they want really to disrupt our operations, or they demand that we give them jobs, and stuff like that. But again, we are able to engage with most people that to make sure that these things doesn't disrupt us or nothing happens in an illegal way. So in a nutshell, that's what communities is. And lastly, maybe from the environmental point of view as well, we've continued making sure that we want to reduce the carbon emissions that we emit in our sites. Over the last couple of years, we were making sure that we are clear of exactly where the emissions are. We now have a clear record on a month-to-month basis. We know exactly how much we emit, and we have embarked on a strategy to reduce that. The first one is being obviously looking at the renewable energies that we want to put on our sites. Obviously, with Eskom giving us problems, this has become even more lucrative that we need to get into it. I think in the next 2 years, we've taken a note on the budget speech yesterday about the tax rebates that will be on the renewable energies, of which we are obviously going to make sure that we ramp up that part of our business. And yeah, all in all, the relationships are good and healthy. We've never had any labor unrest. Communities have not yet stopped us or haven't stopped us because of the way we engage them. And even the authorities, meaning the Department of Mineral and Energy, Department of Water Affairs, we have a good relationship with them. We have a team that's day to day, make sure that we have a good relationship. We are proactive in what the needs are from those authorities. And that has actually given us an advantage in how we do things, because whenever we start new projects and then we go and apply for all these approvals and emissions and stuff, it seems to be it's so seamless for us that we do get our stuff on time that we need to get, and it's the way we approach things that has helped us. But yeah, in this environment that we are at, we believe we're doing a great job to try and keep those relationships. And in a nutshell, that's let's say our ESG and this.
Thanks, Colin.
Thank you, Andries and Colin. Andries, could I ask you to stop sharing and to ask Brad if he could share his screen with us and go ahead with the capital appreciation presentation?
Sure. Thanks very much, and good afternoon, everybody. Thanks for joining us. So we couldn't be a more different company to a mining company in what we do. We are a technology company focused on the financial services sector. And so I will walk through this presentation. It will be available on our website later today if anybody wants to look at it again. Within our business, we have two divisions. One is focused on payments, payment infrastructure, providing credit card machines, debit card machines, processing those transactions, facilitating payments on behalf of retailers and banks. We have a business which develops software historically for financial institutions, but as I will show you later on, we have expanded into other areas, and we have an international division based out of the Netherlands, which focuses on doing work across Europe and in Asia. In these presentations, I'm never quite sure about the level of knowledge of people who are joining us. And so today's presentation is going to give you a quick overview of our investment case. When I thought about what are the key takeaways that I want you to walk away with, I can put it down as a few bullet points. Within our industry, there are strong positive trends of growth that we are participating in. The market opportunity that we are going after is substantial and material, and we are well positioned. We are a trusted partner already to established customers, so we're not a startup. We have some startup businesses, but as an organization, we are well recognized. We have a demonstrated leadership record. We, like Afrimat, are cash generative. We have a very resilient business model, and even through difficult times, we have performed as quite nicely. We have a very healthy balance sheet with a large cash balance, which we too are going to be applying and have already applied for acquisitions and for incremental growth. So as we go through the presentation, keep those key themes in mind. To give you a quick snapshot of Capital Appreciation as an organization, our financial year ends March. So the information I'm providing you is as of September 2022. I am not going to focus too much on the financials because we're about to enter a closed period, and the data that I have here is a little bit dated. So our half-year revenue was 540 odd million rand. We had EBITDA of 138 million rand, which shows a very nice EBITDA margin. In terms of the size of our organization, we have a little under 500 people, and that is twice the size of the complement that we started out with when we first made our series of acquisitions. We are operational in 20 countries, and for a small company, that is something that we are quite proud of. In terms of our payments division, I'm sure all of you use credit and debit cards and shop at restaurants and pay for petrol on petrol station forecourts. The number of terminals that are in the market, many of those supplied by us, has increased by 6 times to 315,000 devices across the country. This is in a little over 5 years, and the value of the transactions that we process has also increased materially over this period. In terms of our software division, we are a leader in the AWS cloud area, amongst others, and we were nominated and recognized as the Sub-Saharan Partner of the Year previously, and we were the Social Impact Partner of the Year in 2020 with Amazon's Web Services division. So COVID was a terrible thing for many. For us as an industry and as a company, there was a real silver lining. Everything went digital. I'm sure many of you have moved on to e-commerce. You have started to think about using your credit cards in a tap fashion as opposed to inserting it into the machine. So that has that has been a big drive that has driven many companies to move to digital. And we as consumers are demanding more and more of that from the large institutions that we deal with. So from an overall perspective, we have found COVID to be a real accelerant for our business across all of the different divisions that we operate. In terms of giving you a quick sense of our customers, you can see all of the large financial institutions in South Africa. As I've indicated, we've moved into other sectors, which now includes retail, healthcare, telecom, and logistics. But it truly is a well-recognized group of customers that we have. We are investing for tomorrow. So in our half-year results, we indicated that we spent about 15 million rand on new products, which I will give you a little bit of a taste of in a while. We have employed many new people. We had 81 new employees from September 2021 to 2022, and those expenses are reflected in our financial results. So we think there's great opportunities to pursue. In terms of our payments division, we had 320 million of revenue. EBITDA was down slightly to 120 million rand. But most importantly, from an operational perspective, the number of terminals that we had in the hands of clients was up 22%. We grew our annuity revenue by 23%. We have launched new products, and the business is in a good position. Our software division had an exceptional half year. It increased revenues by 75%. EBITDA was up by 57%. You can see it has a very strong track record of growth. And we have some very exciting opportunities that we are pursuing, and clients with growth initiatives in South Africa, in Europe, and in the Asia Pacific region. As it relates to our international division, revenues were up 195%. Our office in Amsterdam has started to gain some traction, and we are very pleased with how the division is doing overall. In terms of demand, there were 136 million terminals that were sold last year across the world. You can see in the Middle East and Africa, that increase was up 36% from the prior year. There are huge drivers of demand for these devices going forward, and that leaves us in a very good position. Our estate has grown very nicely, as I've indicated, and here's a graphic just to demonstrate that. In terms of new opportunities, we have a product which allows any Android phone to become a payment acceptance device. That's called Halo Dot. The opportunities for that are global, and we are pursuing those. Great opportunity. We have developed a capability to accept payments on that in South Africa. We have named that initiative Dash Pay Glass, and within a few minutes, you can decide to become a merchant and accept payments. So very exciting opportunity. Layup is a lay-by solution that allows everything to be digital. It has a great range of functionality and flexibility. The largest order that we processed was 550,000 Rand, and our smallest order is only a few hundred Rand, or 80 Rand was the purchase here. So a really exciting opportunity. In terms of cloud, which is the synthesis business, the real reason for doing this is business agility and increased opportunity. In terms of this magnitude of this opportunity, we have seen a report by McKinsey, which talks about the opportunity being $1 trillion in size, which we think is just a phenomenal and compelling area to be in. The operating units within synthesis cover a whole host of sins. They are reflected in front of you. I am going to demonstrate what they do by way of a case study, which I find unbelievably compelling to show you the power of technology. For a large South African bank, they have a call center. The call center was handling approximately 10 million calls a year. Each call on average is about 30 minutes. And there is a regulatory requirement that they screen approximately 5% of those calls for compliance reasons. So if you take 10 million calls a year, that turns out to be about 41,000 minutes of calls that need to be monitored on a daily basis. You cannot do that with human resources. It just makes it sub-economic. With the ability of technology, we have been able to allow all of the calls, 100% of the calls, to be screened, and all you require is one person. So a hugely powerful capability that is enabled by the synthesis team. Another use case is the work that we do for design around onboarding activities at Capitec Bank. Many of you may own Capitec as a stock, and they've done exceptionally well, as you know, and their user experience is critical. And we're proud to say that we have been involved in some of those activities. From a cash flow perspective, the business is robust. Our businesses are cash generative. We've generate a sizable portion of an amount of cash every period, and we have paid healthy dividends. So overall, we think our position is strong as an organization. We are quite bullish on the future. Technology is an area that we think has tremendous growth opportunities, and we would be happy for you to join our room and ask us questions. So thanks very much for joining us.
Thank you so much, Brad. Just as a reminder to everyone, you can now choose your breakout rooms by clicking on the room at the bottom of your page, and then you can ask the questions to the two companies. We'll see you back here in a little short while. Thank you. The finance goes, do you maybe want to start with the questions, because we haven't got much time left?
Yeah, I agree.
Okay.
That's fine. I think if people are still wondering which room to choose, then they'll have to miss out on the beginning. So thanks everyone for choosing the Afrimat room, I suppose. And thank you to the team from Afrimat for the presentation. It was super interesting. It always is. So I'm going to jump into a question that I received from the floor, and it is really interesting. It's something that I've never seen asked before in terms of the way it's termed, but it's a really, really good question actually. And that is the risk of over diversification. Such a cool question. So obviously diversification helps reduce risk, but I think the point of this question is, if you're spread too thin across too many different projects, can you give them the requisite attention? So I'm going to kick us off right there, because I think that's such a big part of Afrimat's story. You know, Andries or Colin, whoever's going to take this one, how do you think about the risk of over diversification in the group?
Ghost, thank you. It is actually a very, very real risk that if you can very quickly overindulge, especially considering all the opportunities that come our way. So the way we do that is to whenever we enter into a new sector, we really actually make it almost a standalone business and we try to build the best possible skills in there that we can find for that specific industry. For instance, when we went into iron ore, we were quite fortunate to be able to build a team of world-renowned experts in the iron ore field. They're running that business for us. And we did the same with our anthracite mine, where we have specialists with underground mining experience of that nature, and the whole thing around the anthracite mine, marketing and everything else. We've got that specialized in there. So I think the dangerous thing would be if Colin and I tried to be an expert on everything. That would not help. So we build these experts. There's a few critical things that we monitor from a high level, make sure that we ask the right questions. And then we are getting to a point where, you know, we're not going to be able to add another 10 minerals to the portfolio, but we can still move around possibly look at some opportunities out there. But it is a real risk and something we're aware of. And I think over the years, what we've done is actually proven that our model works very well.
Yeah, it really does. I mean, the results kind of speak for themselves. And there are a lot of examples of companies out there that are diversified, and all that ends up happening is one division does well, one does badly, and the thing goes sideways. Whereas yours tends to go up, over time. Obviously, everything has its years, and we know these are cyclical plays. But I mean, it's a feather in the cap of the team. Something I want to just touch on maybe as a follow-on to that, and it's exactly right, I suppose, to recognize that you need experts in each business. That leaves the center as very much a capital allocation strategy. Ultimately, I mean, you're sitting at sort of top level deciding how to allocate capital to new opportunities to support the existing businesses to actually grow this thing. Something I just want to pick up on from your presentation, which I thought was really impressive, and people forget this, is Afrimat has managed to grow basically through internally funded cash flows. Ultimately, you haven't actually had to go and do much in the way of capital raising to grow. And people underestimate that, I suppose, as a benefit. A lot of mining companies are quite cash hungry, especially when they're doing new projects. Everyone knows which those companies would be, and that's just fine. That's kind of part of the deal of junior mining, which Afrimat is not, obviously, and that's the point here. Do you foresee a world where you do a really big acquisition that maybe needs a bit of a showstopper capital raise? Would you ever even consider that, or do you quite like this theory of just adding on minerals as you go, nice and just gently, I suppose, is a good way to put it?
Ghost, can I just go back on something you just said before I try to answer the question? I think the short answer is we'll not easily go for a big transformational deal and a big capital raise, but I'll get to that now. Just on what you said on the central point of doing capital allocation, that is not our only job. It's actually resource allocation, and there's a big difference. Capital is one thing, and it's something really important. It's the lifeblood of the business, the cash flow that you generate. But making sure that the business is resourced properly with the right people in the right jobs. So each and every staff appointment is still signed off by myself and Colin. So we make sure that those resources are allocated correctly. We make sure that the equipment that is allocated correctly. And probably most importantly in South Africa right now is the stuff that Colin was talking about, making sure that we have the right approach to get our social license to operate, to have the right relationship with the community and that sort of thing, and then standing back and asking the difficult questions. I always say, I actually learned that from my original business partner. I don't have to be able to lay an egg, but I must be able to smell when it's rotten. And that's our job. Then getting on to your question about capital raise. We did do a capital raise last year when we became a little nervous about what's going on in the economy and things like that. And we thought, just make double sure, and we'd rather come back to the market and apologize for being over conservative than come back to the market and apologize because we burnt our fingers. So in essence, we probably could have gotten by without that capital raise. We like these incremental growth businesses. Our compound average growth rate in after-tax profits from February 2009, after the global crisis, until February 2022, which is our latest full year numbers that is available, that compound average growth rate is 22.5% per annum. And so that 20-mile march is what we really want to try and do. We never bet the farm because you can get it wrong. And we have made mistakes over the years. And then you don't want to feel sorry that you've put everything at risk. So short answer is no, we won't easily do such a transformational deal.
Yeah, that makes sense. I mean, the old advice, maybe more applicable to tech startups, is, raise money when you don't need it. I'm not sure it fully applies to more mature companies, but there's nothing worse than going with your hat in your hand when things are problematic and saying, oh, we need money now. That's never pretty for shareholders. There's lots of examples on the JSE of companies that have had to do that, and it's never pretty. We've actually had a question from the floor, which ties in beautifully with this, which is, with the cash that was raised, the acquisition that didn't complete, what has been done with that cash? How much is available for additional acquisitions? I guess just some commentary around, the state of the balance sheet and the plan there.
So what we did, we had an acquisition called the Krabbenhage manganese mine, which in the end there was a water use license issued that made the mine unmineable, and we decided to walk away. That capital we then allocated to Nkomati, and we ramped where Nkomati was designed for a 60,000 ton a month run of mine feed to the plant. We've upgraded that now to 100,000 tons a month. So we've done an upgrade to the washing plant, and we've also now opened up additional mining space in what we call the L block. We've also brought in some extra kit to be able to mine that. So a big portion of the capital was put to work in Nkomati. The rest was put to work to acquire the rest of Glenova. And as we speak, we actually are debt free with a little bit of spare cash in the bank.
Fantastic. So moving on to a different tact here, there's a question around the sort of shift to the mining sector, and just some more details around, I think it's quite a high level question, but it's, issues with government departments, to what extent that might be relevant, sort of rough timelines, just I think more details around that shift.
The shift is actually very simple. The JSE felt that given that our construction materials business is now less than 20% of our annual profits, the JSE felt strongly that we cannot be listed in the construction materials space anymore, so we'll move into general mining. That shift is probably going to happen early March. There's not a big implication. We were publishing resource information or competent persons reports on our major resources, which is our 2 iron ore mines and our anthracite mine, and over time we'll also do it on our phosphate mine. That is all we need to do. We probably have to do it a little bit more thoroughly, but we've built that skill as well to be able to do it correctly. From a government regulatory point of view, it has no bearing. We have our relationships with the government, and there's no link between what the JSE wants and the DMRE and all the other departments.
And Jess, you're missing a trick here. The right way to do this on the JSE is to wake up in the morning and call yourself an investment holding company. Then you fair value all your assets and have this massive gain in the first year. I mean, haven't you been watching Sense? No, I'm kidding. I'm pleased you don't do that. So questions around... Sorry, go. I'll let you talk.
I just wanted to say, I believe there's an expert in Stellenbosch that can advise me on this sort of thing.
Yeah, we'll leave it there. Questions around South African infrastructure. So, we have to talk about this, obviously. So the 2 big ones are obviously Transnet and Eskom. We know this. The first one around Transnet, what's interesting with Afrimat is it's a mix of international demand and local demand. And I heard you talk about less exposure to international iron ore prices. A lot of people look at the mining sector and they just tar the whole thing with the same brush. They read about Kumba iron ore and they go, oh my goodness, Transnet, or Tungela with coal and Transnet. And I think just some commentary around, from an Afrimat perspective, if you look through the whole portfolio, obviously Transnet is an issue, but a lot of the stuff is domestic as well. And I think just to help people understand that, and then we'll get to Eskom.
I think on Transnet, on the export line, and I can only speak for our own experience. I cannot speak for Kumba or anybody else. But we had a strike, the Transnet strike last year, which was a pain, and then they had their shutdown. But that's normal. Other than that, they've actually been performing very reliably, and very close to where they should be. They can improve, but they're not that bad on the export line. It's excluding October to end of November last year, the rest of the year was actually not too bad. And it was actually better on average than the previous year. So we really cannot complain about that. The domestic line is a problem, and it's a combination of cable theft, locomotive not being available, vandalism, a whole lot of well-known issues in South Africa. And obviously, you can sit back and sit on your hands and complain about problems. What we've done is we've actually got Colin has got a guy working for him who looks after our logistics, and he's just an exceptional individual. And he got together 80 trucks, which runs on a continuous basis, and he moves an additional 1,800 tons per day at the moment from our mine in the Northern Cape to Thunderbale Park. It does add to our problem on the roads, but as a company, at least we're getting those sales. So Transnet on the export line, not so bad. On the domestic line, it is a big challenge.
That's very interesting. Thank you so much. And then let's just deal with Eskom. I mean, load shedding has pretty much been beaten to death by everyone, but we have to talk about it. How's level 6 treating you, I suppose? And what are the plans, bluntly? I think level 6 is here to stay. Let's be completely honest. It's not going to just disappear.
So on the bulk on the iron ore mines, we have a thing that we have a load curtailment. So I think it's up until level 4. That's not too bad. After that, we become very reliant on diesel generators, and we need to plan very, very carefully to really utilize the time that is available to us. Fortunately, we've actually become quite good at this load shedding thing as a country. We can actually plan according to schedules now. So at least we plan around that, and we haven't run out of stock because of load shedding, and so haven't lost any sales. A little bit of extra cost on diesel generators, but it's not in the bigger scheme of things. It's not breaking the bank. Where it does hurt us is in our industrial minerals business. For instance, in Vredendal, where we have a kiln, the throughput through that kiln is a very low rate. And if you look at the amount of energy needed, electricity needed, and to try and generate that with a diesel generator, just makes that product uneconomical. So that is where we lose a little bit of sales. Our industrial minerals businesses are hit the hardest by that. But it's a reality. So we are busy. Our first PV plant is going up. Colin and I were just talking about the concessions that was made in the budget yesterday. Now we can jump onto that very quickly. And PV plants are not the solution, but it does help.
Yeah, South Africans are so resilient, right? In 3 years' time, we're going to be saying, we're very good at stage 8, and occasionally Eskom comes back online, and then it's really helpful, but otherwise we're fine. I mean, that's where we're going, right? I think we all know this. Moving away from our infrastructure, which we know is a pain, and maybe onto some happier things. So there's a question around what are the other opportunities that you're looking at exploring across, all the divisions, I suppose. It's a very broad question, obviously, but I mean, high level, where's the sort of focus area for growth is maybe the right way to just couch that question.
I think there are really 3 legs. The one is to really make sure that our existing assets are giving us the best they possibly can. And I suppose the best example is taking in Nkomati from 60 to 100,000 tons of ROM. You know the mineral, the resource, you own everything. You can just extract a little bit more if the market allows you. So that's the first phase, getting your efficiencies up and getting your utilization as good as you possibly can. Second leg is to execute on our existing projects, specifically Glenover, to get the SSP up and running and to get our strategy refined for going forward and to get the full value out of 3 very strategic minerals. And then the third leg is our business development team with the acquisition or the mergers and acquisitions that we look at. It's actually amazing the number of opportunities there are in South Africa. It's just amazing. And so, the big thing is there to make sure that you choose wisely, remembering what we said in the beginning of over-diversifying, don't get into that trap. But yeah, those are the 3 things. And looking at the different minerals that have strong market dynamics and good prospects.
I do need to ask you about future materials and minerals, but I've got one other one that I also want to cover first. So with the budget speech obviously now hot off the press, I attended a really cool sort of panel discussion this morning hosted by Treasury One. And one of the comments that stuck with me was one of the economic experts there said, you know, this budget looks like we're shifting a little bit from incentivizing consumption through to incentivizing investment, generally speaking, and how public sector investment has just been woefully inadequate in recent years. Now, obviously, in the construction materials side of your business, infrastructure investment, I would think, is quite important, right? A lot of it must surely be driven by government. Just any thoughts around, you know, the outlook for that? I mean, we did quite well as a country out of the commodity boom during the pandemic. Obviously, load shedding is a huge issue, but I think we've come out of the pandemic stronger than some expected. What do you think that means for the construction side of the business in the public sector? Are you feeling a little bit confident about that or still a bit cautious?
Yeah, I'm still a little cautious, but you know, we've seen some very positive signs. You know, Colin and I know the new CEO of Sunroll quite well, and we were very happy to see him taking that job. And we've seen since he moved in there, we've already seen some movement. So Sunroll is obviously a big part of the government spend on construction materials from where we sit. There are three elements to our market. The one is government infrastructure, and that basically a lot of it is road building, road maintenance, that sort of thing is very important in our lives. Then there's commercial building, the shopping centers and warehouses and things like that. And then there's residential markets. The residential market is not too bad, and it's keeping our business alive. We saw a sharp decline in commercial building. And I think that has a lot to do with business confidence, and load shedding and all these other things going on in this country definitely doesn't help that. So if government infrastructure starts picking up, and hopefully it will, then that should really help the industry a lot.
Thank you so much. I think we've got time for one more, and this is going to be a little bit about these commodities of the future. We can't ignore this. You know, you talk about future materials and metals. I just think for people, again, who maybe aren't experts in the sector, when you say a future material or mineral, what does that really mean versus a legacy commodity, or fossil fuels is the term that everyone always uses?
I think if you look at something like rare earths, there are many elements in that group. But some of those elements, for instance, are used for permanent magnets. Every single electric motor has a permanent magnet in it. So whether it's electric cars or whatever you use electric motors for generators, it'll be used in there. If we look at phosphates, we also see it as almost a mineral of the future, because it's such an important part of fertilizer. You know, you speak to a farmer, he'll talk about NP and K, you know, nitrogen, phosphate, and my English is letting me down. I can't remember the potassium.
Don't feel bad. I was going to call it Gravenhage earlier, which is the most Afrikaans second language matric pronunciation in the world, having heard you say it properly.
Okay, but so phosphate is one of the three key minerals in fertilizers, and looking at food security and where things are going, and looking at the phosphate supply in South Africa, now that is really an exciting thing. And then, yeah, vermiculite, I would probably not call it a future mineral, but it is a mineral with a very strong demand, and a lot of the well-known sources are dwindling. So the demand has really opened up a lot. But it's really the rare earths that gave that sector the name in our business.
Last question, which we might be able to sneak in. Any comments on potential export opportunities in the anthracite side of the business, and quality of the anthracite is the question.
So our anthracite is really of a good quality. It's got extremely low sulfur contents, which makes it very sought after. There is an opportunity to export, but we need to ramp up to the point where we are supplying our existing South African customers to the point where we really fill their demand. And as the mine is ramping up, hopefully we'll get there. But for now, the focus is on supplying our local customers. We have a fixed takeoff price. We know what we get. It's a reasonable margin. That's what we are focusing on for now.
Fantastic. Thank you so much. I see the breakout rooms are closing in about a minute and a half. So I just want to thank you, Andries, Colin, for your time, and to all the attendees and just your support of sort of not just retail investors. I mean, there are obviously lots of institutions and analysts who like to use their Gmail account to join us here on Unlock the Stock, which we are always very appreciative of, and we enjoy having them here. But congratulations, I think, on what you're doing, and yeah, just good luck in continuing to navigate these infrastructure issues. The comment from my side would be South Africans always seem to just find a way. It's the one amazing thing about our country, our businesses, everyone just tends to find a way and get on with it. So kudos to you. And to everyone else, I think, you can leave the breakout room. It'll close anyway in about 70 seconds. Then just join us back in the main room just for some closing comments. But Andries, Colin, thank you. And all the best in navigating what we know are pretty difficult conditions.
Only a pleasure. Thank you, guys.
Hi, Brad. It's Mark here. I just want to check, have we got Alan and Michael with us? There's Michael now.
Yeah, I'm here and Brad's here.
Yeah, Brad, and I don't know if Alan has come across yet. Got about 50 people in here, but I can see his name there, so I'm assuming he's just joining us now. I might just kick off the questions just to get the ball rolling here. And this is probably more, I don't know, Brad or maybe Michael, you want to take it. We've seen a lot of the tech guys in results that have come out for Q4 in the US over the last few weeks, talking as the CEO of Microsoft put digitally optimizing spend or whatever. And I'm just wondering, have you seen any of that in the synthesis business just broadly, whether it's, the project pipeline slowing down slightly or, not looking for such advanced kind of work, they just want to get a basic kind of project up running and done, or, what's the kind of feel around the industry in a South Africa context? Are you kind of noticing any changes, or is it, still kind of, a really kind of robust period for you guys?
Yeah, thanks, Mark. So I think we are very different to the US market in many dimensions. Skills is a very different profile here. Demand is also quite different. And also we're a very different business to some of those larger tech providers that have much bigger staff bases than us. But what we're seeing is very similar to what we saw last year. We still have our customers that have long-running projects that they're continuing to develop. We have new business activity that's along the same lines as our existing business profile from previous periods. So we're seeing something quite different in the South African digital and technology market that maybe some of these large entities in the US and Western Europe are seeing. So it's business as usual for us. We had a significant intake of graduates in the January month into our business, the largest ever that we've had in the synthesis history. So all progressing along those similar lines.
And one from the audience, Brad, maybe for you, a question about where do you see future growth mostly coming from? Would you say it's evenly split at this point? I know the payments division is exciting with the Halo Dot and Layup and a few other things, and since this business is still powering along. So would you say it's evenly split, the future growth opportunities, or do you think one is going to maybe accelerate if we look on a kind of a 1 to 3 year view now, once we've got this COVID noise kind of out of the system?
So I think the view over a 1 year period versus a 3 versus a 5 year could be quite different. When we think about growth, we think about growth over a 3 to 5 year period. And I think there are great opportunities in both segments. In the short term, we are seeing a much more robust level of growth as we did in the last half year within the software business. because payments is tied to the economy. So payment activity is tied to the economy and to the economic cycle. So the level of growth there is not as robust as it is in software. But in software, we are seeing a tremendous opportunity. Over the longer term, though, the move towards digital is going to have a marked impact on the growth opportunities within payments.
And then a question, this is definitely a pertinent one. I don't know, maybe might be one for Alan now that we've got him here. Impact on inflation, Alan, in terms of, when contracts come up for renewal, where there are maintenance contracts on the synthesis business, and just, within the payments business, the fees that you charge for the service, for the machines, how does that all get kind of worked into the system? And, are you getting kind of major pushback from customers, or are they kind of recognizing we are in an inflationary environment and they are going to see maybe increases that are maybe potentially higher than they've been used to historically?
I think the characteristic of the inflation rate in South Africa is encouragingly lower than it has been for many years. I think we used to experience, particularly in the 80s and the 90s, and perhaps even in the early parts of the 2000s, significantly higher inflation rate in South Africa. So to a large extent, we are pretty much driven by the CPI inflation rate in our agreements and our contracts. Fundamentally, I think where we have a bit of a mismatch is that we're only able really to get sort of CPI, which could be in the region of about 4 to 6% increases on an annual basis, whereas the actual skills demand in the sectors, both in our payments and in our software divisions, are very, very scarce. And accordingly, we are having to absorb to a large extent higher sort of increase in payroll above what we may managing to achieve. But I think we've been successful in improving our operating margins and our EBITDA margins by virtue of the fact of productivity efficiencies that we've created. The other factor in our payments division is obviously there's an influence of the South African exchange rate. And to a large extent, we are not exchange rate speculators. So we cover forward all our exposures in terms of our purchases abroad, with the terminals are all imported. And so we do pass the impact of the exchange rate. So we don't have the big vagaries of exchange rate, but it does have an impact there. There's inflation is driven by the South African exchange rate.
And just when you mentioned the international businesses, I don't know, Michael or Brad, if you want to take this up, but the business you acquired in the Netherlands, it's probably just about over a year ago now. Is that fully integrated within the synthesis business, and is it kind of performing to your expectations?
So the business that we acquired in the Netherlands, it was only a small minority investment in 2 companies that were based there. We started up an initiative ourselves in the Netherlands, which is fully integrated, 100% owned by us, and is performing really nicely. As it relates to the companies that we invested in, they are cash flow positive, they are performing nicely, but our interest there is only a minority interest. So there are 2 separate initiatives that we have going on in the Netherlands. As it relates to our international expansion, which is being driven to a large extent out of the Netherlands, as we indicated, the revenue that we generated through those divisions were up approximately 200% over the course of the comparable period. So the businesses are doing quite nicely.
Yeah, if we just stick on the acquisitions, Brad, we still see tech, valuations way down from where they were 18 months ago. Interest rates are way up, which makes it harder for the PE guys to get the DCFs to work out as they'd like. And obviously, you've got a large cash balance sitting there ready to deploy. Have, I guess, founders and kind of tech executives, have they realigned their kind of pricing valuations for what they might accept, or are they still kind of rooted into what it was maybe 18 months ago, and prefer to pivot or downscale and try and hunker down rather than entertain transactions at current day multiples?
So we have seen both. We have seen some who are stuck in the past and live in dreamland, and we have others who are much more pragmatic, realistic, and understand the wisdom of joining a larger organization. So we continue to have lots of conversations. We're very diligent in how we pursue these transactions. We are very cautious in how we spend the money. We are not punchy in terms of the multiples that we're prepared to pay, and we need to do something which is value accretive to the organization. So we will continue to pursue acquisitions. The one that we did last year has turned out to be a really good one. Michael, they report in through Michael and are doing very nicely in responsive. And we will continue to grow the business by acquisition.
And if we can just talk about Halo for a second. Obviously, load shedding, as anyone who's based on the ground here in South Africa will tell you, has become a persistent feature rather than a couple of months. Has that led to more of a focus on the Halo product, given it's a mobile offering that they can run as long as their kind of phone is charged? Have we seen a shift away from the terminals to really starting to think about doing everything off an iPad or a phone for some of the merchants where that is an option? As obviously it's not going to work for somebody like a ShopRite, but for those kind of small to medium type merchants, have they started engaging more with the Halo product?
So
yes, carry on, Brad.
Mike.
Yeah, so you're spot on, Mark, that the large big box retailers, will not be looking at shifting away from terminals that are integrated into their environments, and they typically do have backup power to support their retail endeavors. So it is a very different market that is going to be using Halo, and it is very early in the genesis of this application globally. The schemes, which is Visa and MasterCard, only this year will approve full rollout of the software point of sale. Previously, it was operated as a pilot, so there were some limitations in terms of how many users could be rolled out for a bank or for a different payment processor. So the opportunity for us, for Halo, is to generate interest and education in that market. It has both a South African opportunity through our Dash Pay Glass initiative, and that's, again, still, as I said, quite early in the genesis of this. But also Halo for us has a very much international sales opportunity. So we are seeing potentially some respite from load shedding to use a mobile device and Halo as payment acceptance on it. And that might be a very South African specific context. But the opportunity for Halo is much bigger than just the South African market. The solution is cloud-based, is passed through the highest levels of security, audit, and compliance by Visa, MasterCard, and American Express. And we have customers in the UK that are live with the solution, and we're looking at expansion into many other markets. So an exciting prospect for us. And yes, possibly a load shedding respite is something interesting for Halo, but it's quite early in the generation of use of this particular solution.
And we've got a question on GovChat and where the Competition Commission investigation is. Brad, have we got any updates from the Commission, or is it still in their remit and the investigation is just ongoing? Or have they given any indication of they're going to publish a final report or determination in the next 2 months, 6 months, 12 months?
So the Competition Commission itself has issued a finding and a report. And the Competition Commission's finding and report was that WhatsApp, Facebook, Meta acted inappropriately and did abuse their position of market dominance. That decision has now been referred to the Competition Tribunal for them to now adjudicate whether or not, as they would sort of as a court of law for competition issues, to adjudicate whether or not they agree that Facebook, Meta, WhatsApp acted inappropriately, and Facebook will present a defense. That process is currently ongoing, and we are quite hopeful that we will prevail in that litigation.
And has there been a date set down for it, or are you still waiting for that?
We are still waiting for a date. There's lots of procedural stuff that is happening in the background before the hearing date is set down.
Okay. And I don't know, maybe this is one for Michael. ChatGPT, it's everywhere. You can't escape it. A question around, ChatGPT, AI more broadly in terms of its impact on capital appreciation, primarily the synthesis business. Is it an enabler for you guys, a disruptor, a competitor? How do you look at the seemingly rapid advances in AI we've seen over the last 12 or 18 months?
Yeah, Mark, it's very topical, and every day there's a new article. I saw one recently about a flood of books that are available on Amazon's Kindle store that have been written by ChatGPT. So people trying to monetize that use for their own personal gain. But synthesis has been focused on AI for many years. We created a division called our Intelligent Data Division 5 years ago to focus on machine learning, AI, and applied AI projects. So we've been quite active. The case study that Brad mentioned for the bank in his presentation for their call center evaluation was delivered by our intelligent data team. And interesting, approximately 2 years ago, we did a project for a large international survey company. They issue surveys to millions of consumers on a range of product evaluations. And they came to us to help them utilize the data that they had to better construct their surveys. And we ran all those historic surveys through something called the GPT framework, which a couple of years ago, if we mentioned on one of these investor calls, people wouldn't have too much knowledge of it. And what we did is we asked the GPT engine, which is the open source engine that ChatGPT uses as its foundation, to generate new surveys that are better worded, that allow the survey company to obtain analytical outputs in a far more meaningful way. And probably 2 years ago when we mentioned this case study, and I think we did mention it in one of our previous results presentations, the audience would have been a little bit perplexed. How does a machine generate surveys? So we're seeing it as very much an enabler, very much an opportunity to create more innovative solutions and products inside of our business and better assist our end customers with understanding their data and getting significant outputs from it. So we see it as a huge opportunity for the synthesis business to grow, and we're utilizing it in-house quite significantly.
Thanks. We've got a question on the payments division, Brad. Eagle-eyed investor saying the Verifone card devices seem to be prevalent at most of the big retailers, Checkers, Woolworths, the like. They're just wondering why capital appreciation haven't been able to make a breakthrough in that market for the really large scale retailers.
Yeah, so that market is what we call the PED market, for pin entry device market, which is different than the use in a smaller retail environment. It wasn't until last year that we had a solution that was focused on the PED environment. With respect to large retailers, they have a refreshment cycle that is a little bit different than traditional banks, and many retailers actually own those devices themselves, as opposed to historically in other areas where the bank rents the device to the retailer. So we have to wait for the retailer to come up for their refreshment cycle of CapEx expenditure for us to be able to compete for that business. We now have a solution. We have a solution with both Ingenico and Newland devices, and we will be competing aggressively in that area going forward.
And just a reminder, Brad, the refreshment cycle on devices, from what I remember, it's about every 4 to 5 years, if I remember correctly from another presentation.
Yeah, for traditional devices, we used to say it's about a 5-year life, with banks now sort of reducing that because there's been changes in technology. So it's come down to about 4 years. But that period of time is a little bit different than it is for large big box retailers who have a more deliberate cycle that's a little bit longer. And because those devices are stationary, there's less damage, less wear and tear. They are fixed to the countertop. So probably it's about a 6-year life cycle is what I would estimate.
Okay. And then another kind of macro-based question. The impending recession that seemingly everybody is predicting for 2023. Again, I think it may be in the South African context, not a major change in the economic environment, given we've been in a low growth environment for the best part of 10 years now. But have you seen, Brad, anything to suggest that it's going to disrupt business as usual for capital appreciations divisions at this stage?
I think we are the beneficiary of a need for businesses to digitalize. And through that process, the nature of the services that we offer continue to be in high demand. So technology allows you to do different things. It either allows you to enter new markets, it allows you to do things differently, or it allows you to manage your costs more effectively. So in a low growth environment where companies are constrained, one of the areas where they continue to look for opportunities is cost savings. And technologies allow you to do that, certainly the types that we offer. So while we will encounter some headwinds, obviously, when there is a macroeconomic issue that you've got to deal with, we think the drivers for the industry that we're in will outweigh that. And we should be quite defensive in how we operate through that period. So we don't think we'll be as affected as many others would be.
Okay. Gentlemen, I think we'll leave it there. I think it'll be a bit much to try and squeeze in another question. So we'll move back to the main room now, and Vanessa will just wrap up. And thanks everyone for joining this breakout room and the questions. It was really good to get the catch up from Brad and Michael and Alan.
Thank you, Mark.
Thanks, Mark.
So thank you very much to everyone who participated in Unlock the Stock today, and a real special thank you to Andries and Colin, Brad, Michael and Alan for making the time to support this investor platform. And Brad, particularly, thank you for the early rise from New York. We hope that everyone else has enjoyed this event, and if you would like to listen to it again, it will be on the Unlock the Stock YouTube channel. Please join us for the next session of Unlock the Stock, which takes place on the 30th of March, where we'll be joined by CA&S Group. So please look out for that invitation. Thank you, everyone. Goodbye.